We welcome you to another video on REITs, another video on many insights on REITs that we offer always. And REITs, like just to as a recap, help you buy properties through stock exchanges, and you hold properties as a unit holder in REITs, and you buy them and sell them as just like you buy regular shares in stock exchanges. And if you are unfamiliar, please visit our website reitspro.com. You can connect with us on various social platforms like WhatsApp and Telegram also. So the question here today is, are REITs a substitute for direct property? The first point here is that the type of real estate that is offered in case of REITs is actually commercial real estate. The commercial real estate that happens to be as per market conditions and sebi legislation. So as you can see here, REITs do not offer vacant land and agricultural land. What REITs give you when you buy a REIT is commercial real estate only today, and residential real estate may come over a period of time, but as on date you are limited in the type of property you get when you buy a REIT. So it does not give a variety to your portfolio. So you get the real estate portfolio that you get is only one type of property. The second one is that what is the stage of the property that you're buying. So you are really buying a property which is completed and not which is under construction. Now what is the impact of this? That you cannot buy property which is under construction. So the first reason for this, let's just outline the reason first. That's because that the SEBI regulations again want that a large part of a REIT's assets should be invested in completed and generating properties. So they invest in completed assets, and the objective here is to derive regular income by way of rentals. What does that mean when you compare that with direct portfolio of direct real estate? So you are looking at actually steady and less risky properties, and these completed properties naturally will have a lesser scope of capital appreciation. When you invest in a project, you are exposed to both risk and higher returns. So with REITs, you are exposing yourself with a steady income and a less risky proposition, but at the same time lower returns as well. The third is that what is the feel that you have in case of REITs versus direct property. So in case of REITs, these factors have to be evaluated. Is it a financial, because it's a financial asset. So what you're not using real estate here in case of REITs for self-use, neither does it give you any pride. I mean, yes, I mean you could say that okay, I own this, a part of this commercial asset, but you cannot show your asset to any of your friends or family, and that's how the social status also does not get displayed when you take these. It's a financial asset, and there is also not a lot of people want the satisfaction of owning real estate physically. That is what you don't get when you buy REITs. So REITs actually becomes another financial asset. It's liquid and it has a small ticket size. Yes, that's true, but there is no connect with the asset physically or emotionally. So that's one REIT versus real estate that you have here, that it's a financial asset only. The fourth part is the taxation. Now in both cases, in terms of REITs and real estate, direct real estate, the tax laws are different. So in case of REITs, for example, it's more in line with stock markets. So income tax rules are about how long-term capital gains on STT paid stocks are there. So here there's a separate video on this also. And income tax rules for direct property, and of course, so coming back to the first one, there are rules as far as the regular returns are also concerned. So income tax rules for direct property, and there are some very useful rules which help you avoid a lot of capital gains tax. So just to summarize here the taxation part, so the recurring incomes in case of REITs are mostly exempt. In case of real estate, there are limited exemptions on recurring income. So if you're taxed as a house property, a percentage is minor percentage is taken out for that. Then there are no capital gains exemption in section 54 and so on for REITs. In direct real estate, you can get capital gains exemption in these sections, and at the same time there are more in line with stock market rules, and there are no home loan benefits available in REITs, whereas home loan benefits are available when you take direct real estate. Having compared both REITs as well as physical real estate investing, we will be summing up the comparison of REITs versus direct investing, real estate investing. But also coming up in this video itself is alternatives to REITs. So are you really using REITs as a substitute, and did you evaluate any other options before you chose REITs? So you could also join the discussions in a forum, a REIT forum, with a link of the WhatsApp group here, or you can also write down on the comment section. Conclusions that we have of REIT over direct real estate. So the first conclusion is that if you are going for a diversified portfolio of properties, then REITs may not be the way right now, because you have only commercial real estate. Then if you are one of those people who want higher returns and are able to take more risk, then REITs may not be for you, because they offer limited risk and steady returns. And third, it's a financial asset. There is no feel to it or emotional connect with it in terms of in case of REITs, whereas real estate is a physical asset with emotional connect also. And fourth, the tax advantages of both vary. It's not that one size will not fit all, so it has to be an evaluation of your own situation and tax planning. So are REITs the only alternative, or are there any other alternatives to physical real estate? This is what we will explore now in this part of the video. So physical real estate really involves managing legality and transactions, and liquidity and bulk money, which is concentrated in one part. This is one of the big reasons. These are some of the big reasons why people avoid physical real estate. So people look for alternatives. What are the current alternatives in the market? Well, there could be, firstly, real estate developers equity. So you have a Sobha developer or a DLF or some other listed entity where all these hassles like managing legality transactions, liquidity, bulk money, all these are avoided. Similarly, there are aggregation portals where you could invest in rent generating commercial property like HBIT, StrataProp and so on. Or there could be private funds. So all these alternatives are definitely present for alternatives, as they are alternatives to you owning physical real estate. However, you also have to closely look at, number one, features. So how close are you to real estate investing? When you're putting your money, are you really putting it as close to real estate investing as you want? This we will explain a little more in detail. Secondly, the safety, liquidity and transparency of your investment is also to be seen. So if you take the first case of developer stocks, the business, it's in the business of development and not investing. So property is really stock and trade, and there is raw material to finished product approach. So it is a little different from an investing activity, buying stocks of developers. The second one is aggregation portals. So you need to see the safety aspect. What about the liquidity aspect and the regulation? These are things that you also need to see. Also, they are more concentrated than REIT investing. The third kind is the private funds. So you can invest as per fund objectives and as per time frame that they have. However, the regulations are less stringent than REITs, and there are more, it requires more investment than REITs, and less liquidity is there in case of private funds in general. So the choice of real estate over physical real estate, REITs over physical real estate scores because of these very reasons. Firstly, it's very close to real estate investing activity. If you are really wary of bulk investing and a hands-on approach to real estate, REITs definitely are the instrument of choice. Thirdly, if you have a problem with the time involvement and risk taking in other avenues, then REITs are the way to go. And fourthly, strict sebi regulations give you comfort, then you should definitely be a REIT investor. And thank you so much. If you have any questions, do write to us at support@reitspro.com. You can connect with us on WhatsApp and Telegram also. And thank you so much for watching the video. Thank you.